Hi everyone and welcome to the We're Gonna Make It podcast show, your go-to podcast for all things emerging tech in just under 15 minutes. I'm your host Harshdeep and today we'll be unearthing the often controversial world of ESG investing. So, are we progressing towards an enlightened era of investing, or is this a complex web of political agendas? Well, we'll just have to find out. So let's get this started. Recently, the debate around ESG investing has intensified with a series of political events. The US Senate has just overturned a Labor Department rule that permitted retirement plans to consider ESG or environmental, social, and governance factors when making investment decisions. This echoes a similar move by the House Republicans as well. And this, my friends, sets the stage for a potential first veto by President Biden. So what exactly is stirring up this hornet's nest? Well, on one side of the ring, critics argue ESG investing is essentially politicizing the investment process. They view it as a vehicle for driving political agendas such as climate change activism rather than focusing on generating the best return for investors. They see it as wokeness wave sweeping over the investment world today. But in the other corner, we have the ESG industry who strongly disagree. They believe that ESG investing is a valuable tool that helps identify risks that might be missed by traditional investing guidelines. They argue that by considering ESG factors, investors could enjoy more stable, safer returns and even uncover profitable opportunities that could have been otherwise missed. Now let's start by unpacking this acronym that's stirring up so much debate. ESG is an investment approach that goes beyond the traditional financial analysis. It takes into account a company's impact on the environment, its social relationships, and how well it governs itself. The E in ESG stands for environment, and here's the thinking. Companies with strong environmental records may be less exposed to big regulatory fines or disruptions from future environmental protection measures. They might be better prepared for climate change impacts, be it potential flooding damage at factory sites or the risks of increased wildfires. The theory is that traditional investment analysis might not fully appreciate these risks, leading to inflated stock prices and high-risk portfolios. Next up, we have S, which stands for social. This factor looks at the company's relationships with its people, both internal and external. Investors might look at whether pay is equitable, if working conditions are good, and even consider the company's stance on major social issues. After all, a happy workforce is more likely to stick around, reducing turnover costs and boosting profits. Furthermore, a company's record on data protection and privacy is also of interest, as breaches could result in loss of customers. And lastly, we have G, which is for governance. Essentially, this refers to whether a company is running itself well. Investors would consider whether executives' pay is tied to the company's performance, whether there's adequate representation on the board, and if directors act as a powerful check on the CEO. With all of this in mind, why is there all this backlash? ESG investing is not just a fad, it's a force to reckon with. In 2022, investors who considered ESG criteria controlled an impressive $8.4 trillion in US domiciled assets. That's equivalent to buying Tesla, one of the most valuable US stocks, more than 11 times over. And no, it's not just the millennials driving this trend. The vast majority of money in ESG investments comes from institutional heavyweights like pension funds, insurance companies, and university endowments. But as the saying goes, with great power comes great responsibility. And as ESG investing gains traction, it's also stimulating more engagement with companies. Annual shareholder meetings are increasingly focusing on ESG issues, and investors are pushing executives to disclose more about their carbon emissions, impacts on human rights, and racial equity audits. And this is a significant evolution from the early days when socially responsible investing was simplistic by only avoiding stocks of tobacco or gun companies. Yet there's a resistance here. some politicians denounce ESG as a politicizing of investment. Tesla's CEO Elon Musk even called ESG a scam and criticized rating agencies that try to condense complex issues into simple ESG scores. And then there's the greenwashing phenomena, where some firms claim to be ESG driven, yet invest in companies with low ESG scores. It's a murky world out there, and it's up to us to see through the haze. Alright, up until now, we talked about ESG investing, its criticism, its relevance, and its increasing popularity. Now let's delve deeper into some key criticisms of ESG investing with insights from a recent report by PitchBook. This report is quite interesting. It was written by Villegas, an expert in fund strategies and sustainable investing. PitchBook conducted an annual sustainable investment survey, gathering responses from over 500 participants. These responses ranged from avid supporters of ESG and impact investing to a significant portion who were marked anti-sustainable investing. Villegas has distilled these varied responses into 5 common criticisms of ESG investing, shedding light onto the intricacies and nuances of this topic. So let's walk through these criticisms. Firstly, she notes that ESG investing is subjective and difficult to substantiate. The standards applied by investment managers may vary widely, and one manager might invest only in carbon neutral businesses, while another might invest in oil and gas companies making ESG improvements. And here lies the tricky part. ESG performance is rather tricky to compare due to the burdensome data collection process and wildly varying data. But there's a silver lining here. The hope is that technology and common measurement systems will simplify this process over a period of time. The second criticism she highlighted is that ESG requires sacrificing returns. This is a common misconception, as ESG investing does not inherently mean compromising returns for positive social or environmental outcomes. Many investors believe that ESG limits the downside risk, which could improve the returns over time. And while it's true that impact investing may occasionally accept below market returns to achieve social and environmental impact, it's essential to remember that ESG and impact investing are different facets of sustainable investing. Interestingly, Villegas also challenges the notion that ESG promotes leftist ideology. She points out that ESG risks themselves are not inherently political. Take data privacy or security risk, for instance. It's hard to assign them a place or a political spectrum. And while topics like diversity and inclusion can sometimes stir up controversies, it's undeniable that discrimination and harassment lawsuits are expensive and bad for business. Let's move on to the third criticism, which states that ESG is redundant and already part of best practices. Now, while it may seem like common sense to follow laws, treat employees fairly, and so on, ESG provides a sophisticated framework to analyze risks related to these ideals. As technology evolves and AI becomes more prevalent, new ethical dilemmas and risks arise. ESG performance assessments are crucial to ensure these risks are recognized and managed together. The fourth critique suggests that ESG distracts from higher priority issues and areas of potential impact. This stems from the confusion between ESG and impact investing again. Primarily concerned with how ESG factors influence company performance, while impact investing seeks to deliver measurable social and environmental benefits. Villegas emphasizes the importance of clear language to differentiate between these two aspects of sustainable investing. Lastly, there's criticism that ESG is virtual signaling, and it rarely involves follow-through on actions stated or implied by these practitioners. However, Villegas states that when virtue signaling involves follow-through on stated actions, it isn't necessarily harmful. Plus, regulators are making sure that sustainability-related claims of financial products are substantiated. So, summarizing the report, ESG risks are inherently political. ESG is an imperfect yet valuable tool that can improve company performance, while simultaneously creating positive societal impacts. Well, that's a wrap on this episode of WGMI. We've tackled the criticism, the myths, and the truths. And here's the key takeaway. ESG is far from perfect. And yes, it is subjective. But it's a valuable tool in our investing toolkit that has the potential to improve company performance while simultaneously benefiting society. It's not just about returns, it's about creating a positive impact, reducing risks, and contributing to a sustainable future. So whether you're a seasoned investor or just dipping your toes in the world of finance, keep an open mind. ESG may have its critics and they may have some valid points, but it also has a wealth of potential. As we forge ahead into an ever-evolving financial landscape, staying informed and engaging in these nuanced discussions is paramount. Remember, we are not just passive observers, we are active participants shaping the world of finance, technology, and sustainable investing. So thank you for tuning in today to WGMI. It's been a pleasure, as always, to explore these thought-provoking topics with you all. If you have questions, comments, or topics you'd like us to dive into future episodes, don't hesitate to reach out. So until next time, stay curious, stay informed, and let's keep pushing the boundaries of what we think we know. Because remember, we are gonna make it. Goodbye.